So why do we choose companies as a particular vehicle, as opposed to a partnership or a trust, or indeed a sole tradership? Now, what feeds into your thinking in choosing the company vehicle are both non-tax considerations and tax considerations. In terms of those non-tax considerations, of course, part of what we mentioned before, the limited liability effect. And what is perhaps a negative in terms of the company vehicle is that it's a little bit more expensive
Yeah.
than other structures, both in terms of setup, but also in terms of ongoing administration costs. What is useful, though, is that if you bring new stakeholders on board in a company structure, you can just issue them out of the company with new shares. And that issuing of shares in itself doesn't have any tax effect. The only time it could potentially become disadvantageous is, as we alluded to earlier, if the shares are issued to related parties for no market value or for no value, then it could potentially trigger those share value shifting rules, Vicky.
Yeah.
In terms of tax considerations, well, certainly the company rate of tax. We now have, for base rate entities, a very low rate of tax of only 25%. So that might be a point of attraction in a tax sense. What is perhaps not a good thing is, and we'll talk more about this later on, is, of course, in a company, the tax losses are trapped. It doesn't flow through to the individual stakeholders. It's trapped in the company. And of course, the company can carry it forward and use a deduction against future taxable income to the extent it passes those required tests under taxation law. But it's not like a partnership where there's complete flow through of the losses to partners. So that might be a detracting element. Once again, in a tax sense, the issue of new shares doesn't really have a tax effect. But of course, when you transfer shares from one shareholder to another shareholder, where there's a share buyback or redemption of shares, those will certainly have tax consequences. It doesn't have, by its nature, a natural leaning towards income splitting, the company structure, because it doesn't have the facility that you can use under a discretionary trust, where you can stream distributions in the way that you choose. You could achieve that effect to some extent if you have different classes of shares. But then, as we discussed earlier, Vicky, you've got to be careful about dividend stripping rules, dividend streaming rules, and indeed Part 4A, the general anti-avoidance provision. Now, there is some concessional effect on the capital gains tax. If I want to move to a company structure as a sole trader, and I transfer all the assets from me into the company vehicle, in which I am also the sole shareholder, then I get a rollover effect on that.
Yeah.
In other words, there will only be a tax effect when the company eventually disposes of the shares. Now, we also made the point earlier that even though directors and shareholders have limited liability, we now know that in the context of superannuation guarantee, particularly, and PAYG withholding, personal liability may in fact be imputed to the directors of the company. Now, of course, we can't offset if you have a corporate group with several entities within that group owned by the same people. You can't really automatically offset losses in one against profits of another entity within the group. The only way you could possibly do that is through tax consolidation. So you have to form a tax consolidated group under which they will be all treated as a single entity. Now, to form a tax consolidated group in this way, to create the capacity for offsetting losses and profits across members of the group, your head entity must always be a company. And so this is where a company structure can have its usefulness as well, to create and facilitate the tax consolidation. something we alluded to earlier, is even though we can issue shares readily out of a company to new shareholders, new stakeholders, and that issuing of shares in itself won't have any tax effect generally. But of course, there may be issues around what we would call share value shifting, as we alluded to earlier. And as Vicky said, we will talk about that later in our program. I think that's in episode 4, is it, Vicky?
Yeah. Well, CGT, complicated stuff.
Yeah. Thin capitalization is also something we want to be aware of. Typically, where we fund an Australian subsidiary company by a foreign controller, and the funding is skewed towards debt funding rather than equity funding. And historically, if it exceeded a threshold of 1.5 to 1, debt versus equity, then any deductions ascribed to interest would be denied under the thin capitalization rules, the company being too thinly capitalized in that instance. But it would only find effect if the total debt deductions, interest deductions effectively, is more than $2 million for that year, which means for most smaller companies, they won't really be affected by the thin capitalization rules because they wouldn't have interest expenditure of more than $2 million.
If you're pretty big, you fall into that,
But it's certainly one of those things we have to be conscious of. And then there's certain integrity measures that only apply to companies. For example, Division 7A only apply to companies. There's no Division 7A equivalent in a trust structure, for example. You can make loans out of a trust all day, every day. And there's no Division 7A equivalent out of a standalone trust. So there is that particular detracting element in a company structure. Now, a company does have entitlement to certain very specific tax incentives that only companies can get. For example, the R&D tax offset is only available to companies for research and development expenditure. Similarly, more recently, well, for a number of years now, since 2016, we recognize a particular category of company called an early stage investment company, an ESIC. And for the investors in those companies, there are certain very generous tax incentives by way of a tax offset and also an exemption from capital gains tax where they sell the shares within 10 years. And so that's only ascribed to companies, that particular ESIC concession.